$5,198. Gold just hit that number this week. Now stop and think about what usually happens when bond yields rise. Stocks typically sell off. Commodities get pressure. Gold gets crushed because higher rates mean higher opportunity cost on holding something that does not pay interest. Except that is not what happened this time. The 10-year Treasury yield is sitting at 4.09%. That is not low. That is elevated. And gold still broke through 5,200. Something structural just shifted. Last week I told you to watch for a specific confirmation in the three lanes framework. I said if we see gold break the inverse correlation with bonds while silver premiums stay elevated, everything changes direction. Both conditions just hit this week. Here's what that means. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where these decisions get made. I watch what happens when retail investors get the wrong information at the wrong time. That is why I am here. Everything I show you today comes from publicly available sources. I will name every one as we go, so you know exactly where it is coming from. If this kind of calm, data-first breakdown is what you've been looking for, hit the like button right now. It tells me to keep making these. And if you're not subscribed yet, now is the time because what we are covering today is part of a bigger picture we are building week by week. Here is what we are actually looking at this week. Gold is sitting at 5,200 and change. That is a record high. But here is what makes this move genuinely unusual. Normally when gold hits all-time highs, it is because the stock market is terrified or the dollar is collapsing or rates have fallen sharply. Usually you see at least one of those three things. This time, the dollar is weak, but it is not in free fall. The stock market is down, but it is not in panic territory. And rates actually went up. The 10-year yield climbed to 4.09% this week. In a normal world, that should have crushed gold. In a normal world, that move alone would have knocked $50, maybe $60 off the price. Instead, gold broke higher. That is not a coincidence. That is a message. The message is that institutions are no longer treating bonds as a safe haven. They are treating gold as the actual safe haven. That is a regime shift. Think about what that means for the next 12 months if that conviction holds. The Shanghai Gold Exchange is trading at 51.57 right now. That is actually slightly below the Western spot price of 5,200. This matters more than you might think. Usually when gold hits record highs, Shanghai trades at a premium to the West. Asian central banks are buying. Private wealth in China is moving into gold ahead of their own currency moves. When Shanghai is trading at a discount, that tells you something different is happening. It tells you the move is not Asian-led. It is Western-led. It is institutions in New York and London and Frankfurt who are panicking into gold right now, not central banks loading up slowly over years. Institutions moving fast right now. The DXY, the U.S. dollar index, is sitting at 98.5 right now. 3 weeks ago, it was at 100.2. The dollar is down 1.7% in 3 weeks. Now, normally that would support gold prices anyway, because gold price in dollars becomes cheaper to foreign buyers. But the timing here is interesting. The dollar weakness started 2 weeks ago. Gold has only really accelerated in the last 10 days. That 10-day acceleration, that happened while the dollar was already falling. So the gold move is not just a currency effect. There is something else happening. That something else is the bond market capitulation. I pulled up the bond positioning data from the CME this morning, and what I found actually surprised me. Short positioning in 10-year Treasury futures hit a 5-year high this week. Traders are betting heavily against bond prices. They are betting bond prices fall, which means yields rise. They are willing to take that risk right now because they believe the macro situation is deteriorating. When traders believe the macro situation is deteriorating, they do not move into more bonds. They move into gold. That is what we are seeing. Think of it like insurance on your house. When you think a storm is coming, you do not sell your house insurance. You make sure your premium is paid and your coverage is strong. Institutions are paying their gold insurance premiums right now. They are making sure their coverage is in place before something worse happens. The geopolitical layer here is real, and it is getting worse, not better. The U.S.-Iran situation has escalated materially in the past 72 hours. That is not speculation. That is confirmed reporting from Reuters and the Wall Street Journal. When geopolitical risk goes from watch and wait to active crisis, the entire cost of capital changes for institutions. It is not just about gold. It is about how institutions price risk across their entire portfolio. Higher geopolitical risk means higher insurance costs. Higher insurance costs mean lower appetite for yield-dependent assets like bonds. Lower appetite for bonds means more flow into hard assets like gold. That is a chain reaction we are watching unfold. The Fed is in a genuinely difficult position right now, and the market knows it. If energy prices spike materially because of the Middle East situation, that creates inflation pressure. If the Fed raises rates aggressively to fight that inflation, they crush the equity market and potentially trigger a credit event. If the Fed does nothing and lets inflation run, they lose credibility and the dollar weakens further, which pushes gold higher anyway. So the Fed either tightens into a weak economy and triggers a crash, or they stay loose and gold continues higher. From an institution's perspective, gold wins in both scenarios. That is why they are moving in now. The institutional behavior we are seeing right now, it is not retail. It is not YouTube traders. It is actual money managers rebalancing their books. The CME data I looked at shows that managed money net longs in gold just hit a 2-year high. These are hedge funds. These are pension funds. These are insurance companies. They are all adding gold simultaneously. When you see that kind of synchronized institutional movement, it is usually because they are responding to the same signal. That signal is, the bond market is broken. The bond market is no longer a reliable safe haven. Gold is. Now, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1, the paper market. Blue lane, gold futures positioning is stretched. The managed money net longs I just mentioned, they are near all-time levels. That typically happens at market tops. But here is the nuance. In normal bull markets, when positioning gets stretched, it usually means sellers are coming in to take profits against that long positioning. But right now, the shorts are not showing up. The commercial shorts, the miners and the dealers who typically hedge by selling futures, they are conspicuously absent. That means there is no natural seller stepping in to cap the move. The pressure valve that usually releases here is not working. Lane 2, the physical market. Gold lane. Premiums in London are elevated. The Royal Mint in the UK has reported strong retail demand. LBMA vault data shows metal actually flowing out of London vaults into private storage in the UK and Switzerland. That is the same signal we saw with silver. When physical metal starts moving out of auditable vaults and into private hands, institutions are planning to hold, not trade. They are moving their insurance policy into their own safe. Lane 3, macro, silver lane. The bond market is in transition. The 10-year yield at 4.09% is not the story. The story is that gold broke the inverse correlation with bonds. That has only happened a handful of times in the past 20 years. Each time it happened, it signaled a regime shift in how institutions thought about risk. The correlation breaking means something worse is being priced in. It means institutions believe the environment is moving from normal inflation and normal rates to something else. That something else is either geopolitical escalation that forces fiscal spending or a financial system shock, or both. When all 3 lanes align like this, when paper positioning is extreme, physical is moving into private hands, and macro is signaling regime shift. Historically, that has preceded moves that are far larger than normal. I am not saying we get 100% rally from here. I am saying the setup is telling you something important about where institutional money thinks risk is headed. Here is the one thing I am personally watching this week. One thing, gold above 5,250. That is the next technical resistance level, and it is not arbitrary. That level has been tested 5 times in the past 3 months. Every time we have approached it before this week, sellers stepped in. This time we broke through. If gold closes this week above 5,250 and holds there into next week, that tells me the institutional buying is genuine conviction, not just panic hedging. If it rolls back below 5,200, that tells me it was a squeeze and we might see a shakeout. That is my watch. That is my call. This is my one call for the week. John, FX Insider. On record. I am putting it on record right now. And I will be back next video to tell you exactly what happened. No edits. No excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Gold breaks above 5,250 and holds. The institutional buying accelerates. The geopolitical situation deteriorates further. The Bank of America target of 5,500 gets tested. That is the bull case, and it is based on real institutional behavior and real macro deterioration. Here is what needs to happen for the cautious picture instead. The Fed signals an emergency rate hike to combat energy inflation. The geopolitical situation cools suddenly with a surprise diplomatic breakthrough. Institutions take profits after a massive run from 4,800 to 5,200. Gold sees a liquidity flush back toward 4,800. Both are possible. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. I want to ask you two things, and I genuinely want your answers, not just a thumbs up. First question. When you think about institutional money fleeing bonds and moving into gold, what does that signal tell you about where those institutions think the economy is headed in the next 6 months? Drop that answer below. Second question. Are you seeing physical gold premiums elevated at your local dealer, or are dealers still pricing off the spot number? Drop both answers below. The comments section here becomes a real-time sentiment tracker, and I read every single one before the final word. If you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. Subscribe, because next week we are going to the Fed's emergency response options, and I will show you exactly how to read the CME Fed Watch tool. That is a skill worth having. And if someone in your life is watching their portfolio get crushed and wondering if gold is actually safe, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your